Hello, Namaskar viewers. I am Sanjeev Pandya welcoming you to this week's episode of the Tax Talk with AJ right here on ITV Gold. The show is sponsored by Science CPS Services, a full-fledged professional accounting firm located in the state of New Jersey with multiple locations. I always say these things because it really needs to be said because they are very professional. They are located in the state of New Jersey, multiple locations, but they can assist you with any tax matter across the state. So wherever you are, you can contact Science CPS Services. 908-888-8900 is their phone number. 908-888-8900. Visit their website, sciencecpsservices.com. For any tax matter, personal or corporate tax matter, or even if you need a virtual CEO, CFO, or even a bookkeeper for your small to mid-sized business, Science CPS Services can really help you out. And over the years, they have developed a very, very happy and a long list of clientele who come to Science CPS Services for all their taxes and accounting needs. And just in case if you are in middle of IRS tax audit or if you have any letter from IRS regarding a tax audit, do not ignore that. Do not neglect it. Immediately contact Science CPS Services because the record in also settling IRS tax audit is also very, very remarkable. So Science CPS Services for all your taxes and accounting needs. And we are thankful to Science CPS Services for sponsoring this show, The Tax Talk with AJ. With that note, I'd like to welcome Mr. AJ Kumar, over 25 years of experience, CPA, CVA, and MBA with Science CPS Services. He joins us every week to guide us and to inform us about the tax reforms, tax laws, and tax and business matters. AJ, welcome to the show. Good to have you.
Thank you, Sanjeevji, and thank you for the kind introduction.
Absolutely. You're most welcome. And viewers, this is going to be the second part of the two-part series. Last week, we started to talk about this capital gains, how to avoid capital gains tax. It's not that you don't pay capital gains tax. I just really want to emphasize that you pay capital gains tax, but there are ways to avoid them for certain time, or there are ways that you can take advantage of the tax rules. And that's the point, that how to avoid them, not how not to pay them. And AJ has been giving us all the information we really need to know. Last week, we covered 4 topics. And now this week, in today's episode, we're going to cover remaining 4 topics. And at the end of this show, we will discuss all the 8 topics in a summary altogether for your reference. All right, AJ, with that note, shall we start?
Absolutely, Sanjeevji, and very well said. This is the year end. Everybody is thinking about planning, strategizing to minimize their tax liability.
Yep.
So if you have capital gain, please do check out the first episode. It's on YouTube, it's on ITV Gold, it's on Facebook. And the second episode will add a lot of value. So no two situations are similar, Sanjeevji. Everybody has a different situation. So not every strategy is going to be applicable to everybody.
Yes, this is not one size fits all.
Exactly. So there are 20 strategies, 25 strategies. We have identified top 8 strategies that we believe will be applicable to most people. So we discussed 4 in the last episode. We'll discuss 4 now. And then, depending on how much time we have, we'll try to summarize everything towards the end of the show. But please check out. We have YouTube, we have ITV Gold, we have Facebook. Yes. So the first episode is available on the internet as well.
All right, very well, AJ. With that note, let's begin the second part of this how to avoid capital gain tax series. And we're going to start with something very, very important, which I said in the last week's closing comments, that we're going to discuss on 1031 exchange. This is a very familiar, very popular category among South Asians because South Asians they invest heavily into real estate, and this 1031 exchange has to do with the real estate and a capital gains part of the real estate. So here is to AJ to start with the basic information on 1031.
Absolutely, Sanjeevji. As you said, if there's one strategy that you want to know, one strategy that made most millionaires, that's 1031 exchange.
Very true.
1031 exchange only applies to real estate investments. So at a high level, the concept is when you sell the real estate and use that money, use the proceed to buy another real estate of similar type, you tell the government, I'm not selling anything. Uncle Sam. I'm only exchanging it, and hence the name 1031 exchange. 1031 is the IRC code. Exchange means I'm not selling. So you cannot charge me capital gain taxes because I'm not selling anything. You sell one property only to use the money from the sale to buy another property. That's exchange means.
Okay, so that's a 1031 exchange. Now let's go a little bit more deeper as far as the exchange period and the other rules apply to this 1031.
Absolutely. You have to be extremely careful when it comes to the rule application for 1031 exchange. There are a lot of companies who does 1031 exchange only. A lot of attorneys, your real estate attorney can help you with 1031 exchange. Very, very simple process. The idea is while you're selling it, within 45 days of the sale, 45 days, it's a very, very concrete number, you have to identify at least one, if not three properties that you are potentially looking at. You don't have to have a contract yet. You have to identify, meaning this is the property I'm selling. After selling this property, I'll buy either this or this or this. This whole process has to be closed. The second property that you're trying to buy must be closed within 180 days from the sale of the first property. So the difference in time between selling the first property and buying the second property cannot be more than 180 days. The proceed from the first sale must all be utilized to buy the second property. You cannot say, I need half the money, I need to buy a car, I need to buy a home, and rest of the money I'll use for 1031 exchange. All of the proceed from the first sale must be used to buy the next property. The property must be similar in nature, meaning if you are selling an investment property, you must invest into another investment property. You cannot be buying the primary home. You cannot say, I'm selling this house, which was a rental property and investment property. I'm going to use the proceed to buy a primary home. That will not be 1031 exchange. You cannot say, I'm selling this property, which was an investment property, and now I will invest this money into the stock market. I'm buying REITs, real estate investment trust, which is a type of stock, which is type of ETF. That wouldn't be okay either. So the property that you're selling, the risk level has to remain same from the property that you're buying. You can sell a shop to buy a residential investment property. You can sell a residential investment property to buy a warehouse, because for you, they're both investment properties, and that will be okay.
All right, so what you just explained, is that the one referred as boot in 1031 exchange category?
No, boot concept is slightly different.
Okay.
Boot meaning the additional money that you're putting in. Let's say if you are selling the first property for $1 million and you had purchased this property for $500,000. Now you're sitting on a capital gain of $500,000. Now you want to avoid this capital gain taxes. So what you do at the time of selling this property, you identify a couple of new properties, but there is nothing available for exactly 1 million. You have to say you are buying something for 1.2 million. Remember, the next property that you are buying, that has to be at least same or more than the property you are selling. All the proceed from the first sale must be used to buy the next property. So the difference between the property that you're buying, in this example 1.2 million, versus the property that you're selling is referred as boot, meaning you have to put $200,000. If you go back to the gambling concept, they used to call it boot to start the play.
To start the game, yes,
To start the game. So that's how the concept comes up.
Okay. Now, that's good. The boot is very, very common and a very usual, reference that they use in 1031 exchange. Based upon your experience, AJ, that you have all these years of experience, what are the common mistakes that taxpayer makes about this 1031 exchange? What is it they really don't know that they should know, when they file the tax return?
Well, first and foremost, please do not try to do it yourself. You want to have professional help around it. There are a lot of rules around it. You don't want to mess it up. Second, you don't want to be touching the money yourself. From the sale of the property, the biggest mistake, if you have to identify in 1031 exchange, after selling the property, money cannot come into your personal account. Money must remain into attorney's escrow account. If you got the money, if you had access to the money immediately, that breaks the 1031 exchange right there. So the money has to remain into attorney's escrow account. Make sure you have the deal closed in 180 days. We come across a lot of situations. Can my 1031 exchange can be extended? Is there a rule for extension? There is nothing like that. So you want to start identifying the next property even before selling the first property. Because you can identify, you can negotiate, you can do all the legwork beforehand. You don't have to be waiting for the first property to be sold before you buy it. If 1031 is in your mind, you know how much the first property is going to be sold for. At the same time, start looking for the next property.
Okay, so this is a very common mistake that a taxpayer makes without knowing it. Okay, all right, and you said the right thing that do not try to do this by yourself. Even though if you
Absolutely.
think a tax software will help you, so and so forth, it's not the case. That's why you need professional and experienced CPAs, and AJ Kumar himself and his staff, which is filled with very experienced and knowledgeable CPAs on hand. They can really help you with this category or any capital gain or any tax matter. So you need to reach out to Science CPA Services. Anything else we need to add on the 1031 exchange?
No, absolutely. So make sure when you're thinking about 1031 exchange, it only applies to real estate. If you have a insurance policy, if you have stocks, even if you are selling the stock and using that money to buy the new stock, 1031 exchange does not apply. Even if your stocks are REITs, meaning based on real estate investment, even if you are giving a loan or investing money into a friend's property, that doesn't help. Meaning there are a lot of strict rules around 1031 exchange that applies to real estate only.
Okay, interesting. All right, so with that 1031 exchange, hope you've got enough information, valuable information that you really need to know on 1031 exchange. Now let's move on to the next topic, which is charitable giving, meaning, you're donating assets. How does that work and what are the rules for that?
So charitable giving is on everybody's mind. And if you do it right, charitable giving can do a lot of good things for the society and for your taxes. So let's start with gifting appreciated stocks first. Gifting appreciated market. So if you are sitting on an asset which has appreciated in value, and if you sell this asset first and then donate the money, you have to pay the capital gain taxes. And your donation is not really saving you that much money. Take an example. If you have appreciated stock, you bought something for $100. Now it's $1,000. If you sell this thing, you pay tax on $900. As opposed to selling the stock, if you donate this appreciated means increased in value, $1,000 worth of stock, your donation is counted at the market value. You get the benefit of $1,000 of donation and you do not have to pay any capital gain taxes. So when your assets increase in value, appreciated asset, you do not want to sell them. If donation is in your mind, donate appreciated stocks, appreciated asset. If your assets or stocks have depreciated, gone down in value, you want to sell them first so you can get the benefit of the loss that you had and then donate the money. So just remember, appreciated meaning increased in value, donate the asset, donate the stocks. If it gone down in value, depreciated asset, depreciated stocks, sell them first and then donate the money.
Okay, all right, very well. Simply that you explained it. With that note, we're going to take a short break. We covered two topics right now, and after the break, we're going to cover two more topics. We'll be right back after these messages. Welcome back to the second half of this week's episode, the Tax Talk with AJ. This is the show, weekly show, brings you the latest and the greatest that you need to know when it comes to taxes. What are the changes in the taxes, the rules and the regulations during the tax season? This show brings you a lot of information, and tax season, we also bring you the information that you really need to know. And one of the most important information I want to let you know is that now we are in end of November. December is just around the corner. It's just getting ready to jump in the door. You have 30 days to decide how you want to save on taxes. It's not paying taxes, because ICPS Services believes in doing taxes right. How you can save on taxes, that means what's your income and where you can invest money, tax deferred money, and then pay less taxes. Because if you really don't know about that, and if you don't park your money in one of those investment plans, you end up paying more taxes. So try to avoid that, but this must be done by or before December 30th. Do not wait till the last minute. Take a look at your projected income by the end of the year, and then if you really don't need that extra cash, invest it somewhere so you get the return on the investment and you reduce your tax liability. And in the detail, Science CPA Services can certainly help you out. 908-888-8900, sciencecpaservices.com is their website. As they sponsor the show, this second segment is sponsored by Suhag Jewelers, one of the oldest and the finest jewelers in town on Oak Tree Road in Islin. Suhag Jewelers, over the years, known for its reasonable prices for gold, silver, diamond, platinum jewelry, impeccable customer service, easy access, and of course, Suhag Jewelers, they have beautiful collection of gold, silver, diamond, platinum jewelry. Whatever occasion that may be in your family, in your friend circle, and you need to purchase the beautiful jewelry, Suhag Jewelers should be one and only your choice. With that note, AJ has the gold rate brought to you by Suhag Jewelers.
Absolutely, Sanjeevji. Today's spot rate was 4140, 4,140. And I see this is very interesting. If you look at January 1st, first week of January this year, 11 months ago, this rate was 2140. So 2140 becoming 4140 in 11 months. You see the growth in the gold rates.
So
And it's expected to continue to grow.
So 4140 could become 6140 by the end of next year. I'm just guessing.
Scary.
This is just a guessing. Just to let you know, gold investment is a safe investment, all right? As everybody is really building up their investment and a safety net investing in the gold, you should be also doing that. So for gold or even silver is on a high track also. So for gold and silver and, your favorite diamond jewelry, Suhag Jewelers. Visit Suhag Jewelers and take advantage of their gold prices, gold bars or gold jewelry. With that note, let's move on now. Our topic, how to avoid capital gain tax. And listen, viewers, take a look. It's avoid, not that not to pay. So just avoid it using the tax rules and regulation that allows you to avoid to pay heavy taxes when it's not necessary to pay heavy tax. You can pay minimum tax and then avoid paying heavy taxes. So now we're going to go to the category number 7, and this is for the qualified small business stocks.
Absolutely, Sanjeevji. So QSBS is going to be the next 1031 exchange. If there is anything when it comes to capital gain taxes that people are talking about, that's QSBS. If you have not heard QSBS, please work with your accountant, work with your attorney, work with somebody. Go on internet, read about QSBS. A lot of businesses are converting their business into C corporation so they can avail the benefit of QSBS. If you are at a point where you're thinking about exit strategy for your business, where you'll be retiring in the next 3 to 5 years, look at it again, QSBS. If you have a situation where you know that this business that you started yourself and have created a lot of value in this business, you can sell this business for millions of dollars. How do you avoid paying the capital gain taxes? How do you not pay the capital gain taxes when you sell this business? Again, QSBS. So let's talk about how the concept works. Then we'll talk about what are the limitations around it, what are the rules around it, and then you please read about it. So as much information as we want to cover in this 30-minute show, it's a teaser trailer. The onus, the responsibility remains on you to learn more about it, to make the right calls, to find it on the internet, to find with the accountant, attorney. This show is only to help you understand what's available out there, so you can ask the right question. QSBS, they call it Qualified Small Business Stock. So the idea here is if you invest money into a qualified business, and the qualified business is very, very similar to SSTB type of business. It cannot be doctor's office, it cannot be attorney's office, it cannot be accountant office. It has to be, and not SSTB, it has to be a qualified business. So there is a definition around it, what qualified means here. So if you invest money into a qualified business, and this business has to be a C corporation, not a flow-through entity, and you keep this money over there for 5 years, and you take this money out, meaning sell the shares of this company, you don't have to pay any capital gain taxes. And this limit used to be $10 million, meaning if you invested $1 million and now you're selling it for $11 million, you don't have to pay any taxes up to $10 million of capital gain. Now that limit has been increased to $15 million.
Okay.
So the rule now, the way it reads, the $15 million of capital gain taxes can be avoided, or 10 times of your basis, whichever is higher, can be avoided by investing money into a C corporation in a small business. And the small business, QSBS, qualified small business stock, right? So small is defined as 75 million. Under 75 million. It used to be 50 million. With one big beautiful bill, the 50 million was changed to 75 million. 10 million was changed to 15 million. So now the way this QSBS section defines small business, that it has to be under 75 million. The issue, the stocks, have to be original stocks. You cannot repurchase the stock. There's somebody else owned the stocks and you are buying the stocks from that company. And why would they do that? They want to promote new business, new investment. The whole idea is to have people who are making money to invest into new concepts, new companies, where they don't have direct flow-through nature, where they don't own the business. And again, this is not meant for a doctor's office, this is not meant for accountants, attorneys. This is meant for businesses like manufacturing business. You're selling, you're making something, R&D business. It could be staff augmentation. If you're a one-man IT consulting company where you are doing the consulting, I see that as SSTB. That wouldn't be qualifying. But if you have any staff augmentation where you have a lot of people who you hire and then you place here and there, then you're more of a broker. I see this still qualifies. So you have to be careful what a qualified business mean. You have to be careful. Similar to 1031 exchange, it's beautiful. It can save a lot of money, but you have to be careful with all the rules around it. Similar concept here. SSTB can save you capital gain tax on 50 million. Even if you are in 20% tax bracket, that's $3 million of saving. Best part, there is no net investment tax over here. There is no AMT, meaning the capital gain that you are saving here, that's free of NIT and AMT over and above the capital gain taxes. NIT could be 3.8% by itself. So not just you are not paying any capital gain taxes, you are not paying any net investment taxes, you are avoiding alternate minimum taxes. So as long as you follow the rules, you keep the money for 5 years. If you keep the money, and you ask me, I don't want to keep the money for 5 years, AJ. What happens if I take the money after 3 years? That's the best part. Earlier is defined as prior to one big beautiful bill, the condition was that you must keep the money for 5 years. Now, they made it more flexible. If you keep the money for 3 years, the 50% of the capital gain is waived. If you keep the money for 4 years, 75% is waived. If you keep the money for 5 years, 100% of the capital gain is waived. So it's a beautiful thing if you are in a situation where you're thinking about selling your business, if you are thinking about exit strategy, if you are thinking about retirement, if you are in late 50s, 60s, and you own a business, QSBS is the key. You must read about QSBS.
Very nice. It's a very beautiful concept. And in the bill, one big beautiful bill, they have made it even more beautiful.
Absolutely.
With this.
If it's possible.
Exactly. So now I have a couple of questions.
Please.
I had a question about 5 years, and then you answer the question 5 years can be 3 years. Nice. $75 million. Now, how do they come up with the number? Is it the valuation of the company, or company, if it's just starting up, then, then a valuation should not be more than $75 million? Or who does the valuation? CPA like you for that company?
We can do the valuation. It's a separate license,
Okay.
a separate accreditation.
Which you have it, your
which we
CVA.
do. So it can be done outside, and a lot of time at that time of investment, it's a C corporation. The market defines the value. Whatever people are willing to invest, that's the market value. For the
Okay,
business.
fine. So that's a 75 million. Now, how does government qualify those businesses which fall into the category called qualified small business?
Absolutely. Beautiful question. So this is a two-part question. How do you define qualified? That qualified means there are certain type of businesses that government wants to promote. And this is how they include it. It's a separate definition. The definition is not exactly as of SSTB. It's very, very similar to SSTB. So you have to be careful. You have to work with your accountant to make sure you understand you're investing into qualified business. Pharmacy could be a qualified business. Doctor's office is not a qualified business. If you are giving shots at the pharmacy, at least 80% of the business has to be qualified in order for the business to be considered as qualified business.
How about restaurant business?
Restaurant is 100% qualified.
Okay. Chalo,
So you
good,
have to
good,
be
good.
asking the right question. Once the business is qualified, you invest money, you must keep it in a C corporation. Most of the restaurants are LLC.
LLCs.
So you have to be, you can convert your LLC to C corp, or you can sell the LLC, the equity into a C corp. Form a
Okay.
new corporation, issue the stocks, and buy the assets of the LLC or the S corp that you have as a restaurant.
Very good. Viewers, you can get more information by dialing Science CPA Services 908-888-8900 or visit their website sciencecpaservices.com. The reason I'm rushing, because for AJ, it's easy to talk. He can give you all the details that you really need to know. But time is of essence, and I'm told we have less than 2 minutes left.
Wow.
AJ, quickly, in a 1 minute, charitable trust remainder, CRT. That's the one we need to talk about quickly.
So remainder charitable trust, the concept here is if you are old and if you don't have anybody to give your asset, or you want to give money to a charity. So instead of donating money now, where you wouldn't know how long you will be living and you want to have access to the money. So you create a trust where you are giving it to charity, the leftover amount. You decide how much money you are giving to the trust. It's a charitable trust. And then you say, I'm giving $1 million to this charitable trust, and this charity will give me $6,000, $5,000 a month till I leave. The day I pass away, this trust automatically gets dissolved, and this trust is going to be, this money is going to be given to these charities with this percentage, whatever the growth is or whatever the leftover amount. That's where the concept comes. Remainder means leftover money in this trust will be given to these charities, or this charity is whatever percentage you decide.
Okay, very good. With that note, we come to an end of this episode. This is the second part of the two-part series. So quickly, let me just summarize. In the last week's episode, we covered primary resident exclusion, then we covered tax loss, harvesting tax credit, then we covered qualified opportunity zone funds known as QOF, and then we covered donate appreciated assets. This all was covered in the last week's episode. This week, we covered 1031 exchange, one of the hottest topics. Then we touched base upon charitable remainder trust, and then step-up basis debt, and of course, qualified small business stocks. So all these topics covered for you to know about how to avoid capital gains tax. For more information, reach out to Science CPA Services 908-888-8900 or sciencecpaservices.com is the website. AJ, as always, thank you so
Absolutely.
very much for sharing the knowledge with us and informing us. I am Sanjeev Pandya, wishing you all happy holidays, happy tax-free days ahead. Enjoy it as much as you can. It's end of November. Remember that in the next episode, I'll remind you about December, what you really need to do. All right? Do take care of yourself. So long.
Thank you.